Tom Bowley, Chief Market Strategist here at EarningsBeats. Good morning and welcome to this Thursday, November 16th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. Let's see, before we get started, let's take a quick look at the futures this morning. I am showing right now diamonds trading relatively flat, down 0.01%. That's pretty flat. S&P 500 up about 0.1%. The QQQ tracking the NASDAQ 100 down 0.03%, so minus 0.03%. And small caps IWM trading also down 0.03%. So I would say this is about as close as you can get to flat in terms of futures. So not looking for a big move one way or another, at least at the opening bell. As far as economic news out this morning, we did have the initial jobless claims, which came in about 4% higher than expected, 231,000 claims versus the 222,000 that was expected. And that was a jump from last month, which I think the revised number was 218,000, but don't quote me on that one. 10-year Treasury yield right now is at 4.46%. That is down 7 basis points. We broke down below a head and shoulder neckline on the 10-year Treasury yield. I'll talk about that in a little bit. We went back up and tested it, and I think now we're moving back down off of that. That could be the catalyst to get the market going again, but it doesn't look like it's going to happen at the opening bell unless we get the big change in the next 20, 30 minutes. Instead, I would be looking at intraday action. Yesterday, looking at the IWM, and I'll get into some of these numbers here in just a minute, but looking at the IWM, one of the things I was looking for was not only a move up in the morning, but I wanted to see the confirmation throughout the day, continuing movement into the IWM. That's not really what we got. We saw the market kind of roll over. It wasn't a huge sell-off, but kind of gave away most of those gains and ended up finishing with very small gains at the end of the day. I'd like to see that change today. I'd like to see some more buying, resumption of some of that intraday buying. We do have options expiring tomorrow, though, for November. These are the monthly options, and those are the ones I watch the most closely. And they point to possible move to the downside. So we've got some mixed signals here that we're dealing with in the near term. I would just point out that we are in November, and I think from a historical perspective, November and December do carry maybe, I don't know, they kind of move to the beat of their own drummer, if you will. They don't move in quite the same fashion intra-month that we see the other 10 months move in. So I still am aware of options expiration, but at the same time, I know that November and December are not quite the same in terms of moving back or moving up in order to move closer to what I consider to be a max pain level, which is where market makers pay out the least amount of premium relating to those monthly options. Moving on, we got crude oil down about another 1% this morning. We're back down below $76 a barrel. So probably maybe get off to a little bit of a rough start in that energy patch based on the crude oil prices. All right, let's take a look at what happened yesterday. So the Dow Jones Industrial Average finished up about 163 points. That was nearly 1/2 of 1 percentage point. S&P 500 up about less than 0.2 of 1%, up 7 points, but we did clear 4,500 on a closing basis for the first time since the end of August. So pretty big move there. NDX, NASDAQ 100 barely gained, up 0.03 of 1%. That was only 5 points, but nonetheless, gains again. We're up testing some pretty big overhead resistance from the end of July, early August. Mid caps up almost 1/2 of 1%, so doing a little bit better on a relative basis. And the small caps up about 0.2 of 1%. So we're still seeing a little bit of rotation toward the mid caps and small caps. It was really strong actually yesterday morning for maybe the first hour or so. And we saw it kind of drift down, and we saw a little bit of that rotation back away from mid caps and small caps, more towards the NASDAQ 100. So again, let's see how that plays out today. I'm really interested. It's one of the keys I'm looking at in the near term, because I can, as I've said, I can sit here and tell you what the S&P and the Dow did every day, and tell you what the last week was and last year and what the formation and everything else looks like on the charts. But honestly, some of our best signals don't show up on the S&P 500 charts. So we need to look beneath the surface to see what's going on. And that intraday movement right now, I find to be rather intriguing. Transports, kind of moving along those same lines as the Russell 2000. Small caps had a big move up in the morning and then came back down, closed near the low of the day. Those candles on those two charts are not looking exactly bullish. But again, we'll talk about those when we look at the charts in a little bit more detail just a minute. Leadership yesterday, a little bit of everything. We saw defensive group, Staples leading. Staples gained about 0.8%. Then we had financials gaining more than 0.5%. And finally, communication services jumping about 0.5%. So we had Staples, the more defensive area. We had financials, which is an aggressive area, but really more value oriented. And then we had communication services, which is an aggressive area of the market, but it's more growth oriented. I think internet stocks. That's what usually comes to mind for me when I think about communication services. Looking at the individual industry groups, just threw a couple up here that looked pretty good yesterday. Recreational products, that's in the consumer discretionary area, jumping 2.27%. Then we had personal products, and that is in the Staples area, up 2.05%. And autos right in that same neighborhood, jumping a little more than 2%. And autos, again, part of that discretionary group. So we're seeing some strength in consumer stocks, at least yesterday. We'll see whether or not that continues, but at least in the short term, getting a little bit of a rotation there. Recreational products, I do want to mention, did clear the 50-day moving average and has cleared here over the last couple of days. 476.81 is the close, and that 50-day moving average was at 469. So we had a nice solid move up and closing above the 50 for the first time in a few months. We're seeing more and more and more industry groups doing this, which I find to be a much more bullish undertone in the market. The more areas of the market that are trading above key moving averages, the more buyable trades that are out there. And I think that slowly shifts the market from being bearish, which it's been, really it's been since back at the early part of 2022. But during 2023, when we made the move up, we saw some of that bearishness drop down. And in fact, back in July, when I said, hey, got to be a little cautious here, one of the reasons why was we saw the 5-day moving average of the equity only put call ratio drop to its lowest level in about 15 months. So now it's back up and it's near its recent highs. But those are the types of things that I like to watch beneath the surface of the market to give me some clues about where I think the market is heading, not where it just headed. That's easy to do. Anybody can do that. So anyway, that's kind of where, the recap from yesterday stands. It was an okay day. It wasn't a great day. Certainly wasn't a bad day like we were seeing during the correction. It was just kind of, meandering higher. I just would like to see, normally in uptrends, what I like to see, and what I took a little chance on yesterday and didn't really pan out, I like to see afternoon buying. And so after we had that big push in the morning and then we pulled back throughout the day, we kept drifting lower and lower. I really thought around 2 o'clock, 2:15 in the afternoon, Eastern time, which was about an hour and 45 minutes to 2 hours before the close, I was looking for the market to rebound. Didn't see that. So I guess maybe from that standpoint, it was a little bit disappointing. But overall, decent action. 10-year Treasury yield. This is what I was talking about earlier. I'm going to annotate this because I think it's really important. Actually, let's switch it to a 6-month chart first so we can see this just a little bit better. And then I will annotate. And I don't know, whenever I have my little idiosyncrasies, but anytime I draw a pattern, I like to use the black lines. And that's any kind of pattern, bullish, bearish, whatever. I just always like to draw patterns using that color. Anyway, I would be looking at this as maybe even draw the line down like that a little bit, down sloping, where we had the left shoulder here at this top around 480, came down, printed the left side of the neckline around 455, moved back up to 5, that printed the head. We moved back down slightly below that left shoulder. Down sloping neckline to me is much more bearish. It just gives more of a bearish feel because the neckline on the left side, that's your first move down. That provides support. So when you see a slightly lower candle body, like we saw back in the second week of November, that tells me that we had enough weakness to clear that left side of the neckline. And then when you get that bounce up, it just kind of gives you that leaning feeling to the downside. I would much prefer seeing a head and shoulder top where you've got a down sloping neckline rather than, I see this all the time. People are always trying to call, I mean, like this right here. Guarantee you there are a lot of folks looking at this and saying, oh, that's a head and shoulder top, left shoulder, neckline, head, neckline. We're moving up to the right shoulder. We're about to collapse. And we just kept going higher. This is trending higher. I've got higher lows. You see the difference? So for me, it's always, I always prefer, I'm going to be more bearish when I see a setup like that. And, you know, to be honest, this was the 10-year Treasury yield was something I was expecting to roll over anyway. So when I start to see a pattern that sets up pretty bearishly, that just gives me more thought that, hey, we're going lower. Anyway, back on Tuesday, we had the big down day. This was the CPI when it came out, much milder than expected. We got the breakdown in the 10-year Treasury yield, falling down to about 4.44% on the close. Yesterday, we rebounded, and it looks like, to me, a test of that neckline. What I use when I get a breakdown like this, I look for possibly a test of the breakdown and even possibly a move back up to test the 20-day moving average. Just in my experience, I used to always trade based on hitting that neckline. So if I was going long, for instance, and we had a bottoming head and shoulder pattern, a lot of times when that you'd get a breakout above that down sloping or even up sloping neckline, and then you'd go back down and test that breakdown or that breakout area, I would sometimes jump in there. And I found that I was getting stopped out because I was keeping tight stops. And I just noticed that on a number of occasions, it would go down to the 20-day and then bounce right back up. So at that point, I started changing my trading strategy and I give it a little bit more room. So in this case, because this is a topping pattern and we have a breakdown, yes, that neckline right around 450 to 450. I mean, I could draw, you know, maybe connecting these lows, but then you have this breakdown. I mean, I guess it's up to how each individual sees the pattern. I think that's probably a better look going from this low to this low, because I think that is the right shoulder now on that 20-day moving average. Then we get the breakdown. So now what I'm looking for is somewhere in the low 450s as neckline resistance. And then we have the 20-day moving average, which is rolling over, about to get a death cross. And this death cross will be the first one in 6 months. We haven't seen one since back in May, where we go. And actually, never mind, that was actually a golden cross coming up. So we haven't seen a death cross in quite some time, going back more than 6 months. So this is pretty significant. When you're talking about interest rates and where you think they might go, to get a death cross for the first time in the last 6 months after this uptrend with a bearish pattern at the top, I think another push lower, if we see another move down below, say, 440, I think this pattern is definitely in established. So I think it's already in. But watch 450s, low 450s up to maybe about the 463 area. What's that 20-day? Yeah, 463. And that's going to keep coming down. But unless we take that out, I think we're going lower in the yield, and that could be a catalyst for stocks. All right, moving on, let's take a look at the major indices. S&P 500. Here is that move back through 4,500. if we inspect, you will see, first of all, the first major counter trend rally that we saw in this correction was back, peaked at the beginning of September, and that high was at 45.41. The high candle body is 45.30. So for me, that's the next level on the S&P. We clear that. Next thing up is that move we saw back to the high in July. That is up just a little bit above 4,600. So a close above 4,600 would certainly be very bullish. We're not far away, just 2%. That's a far cry from the 10% correction that we had. We've made up most of that ground. And after taking, 1, 2, 3 months to get that 10% correction, it's taken all of about 3 weeks to get most of it back. That's the kind of surge that I was referring to back earlier in the year that I thought we would see in the fourth quarter. Like I've said, I think it's underway. Could we pull back? Yeah, I mean, you've got gap support levels. You got the rising 20-day moving average. I mean, there's certainly no guarantee. And as I said yesterday, maybe this is a left shoulder. Maybe that's a neckline, head. Maybe go all the way back up here, test the neckline. Maybe we do pull back one more time to maybe that 4350, 4400 area to put in what could be a right shoulder, and then maybe another blast off. There's a lot of different ways the market can go, but the key for me is that I believe the uptrend is now in play, and I would be trading this as an uptrend as opposed to the last 3 months where we had to respect that downtrend until it ended. So I think the market's looking much, much better at this point and can be traded accordingly. NASDAQ 100, look at where we are, all the way back at the July high. So this one in 3 weeks made it all the way back. Got back everything it lost in 3 months, right back in 3 weeks. Pretty bullish action. IWM, here was the downtrend. Definitely a big breakout that came on Tuesday. Yesterday, this is what I was referring to as that candle that didn't look so good. See how we opened up, and I'll come back to this, but let's look at that 10-minute 5-day chart. This is the morning strength that I was talking about yesterday. And then we made this little, pull back, and I really thought the end of the day was going to turn back up again. So I actually got a little bit more aggressive early, right after 2 o'clock on this pullback as we got close to this low. And then we just kind of went sideways, and I ended up getting a little less aggressive at the close, just taking it out. Because, again, what I'm looking for now from my own personal trading is I'm looking to get aggressive from time to time. And what I do know about uptrends is that we tend to finish stronger in the afternoons. So we're kind of getting away from what we had seen previously. We went back over the last, we could go back the last 3 months. But a lot of times what you would see is maybe some weakness into the close on some of these days on these pullbacks. But just generally downtrends. Now what I'm looking for is more uptrends. And so maybe a little bit more strength into the close. I would like to see the low from yesterday hold. So on the IWM, that's 178.11. So right now, intraday or pre-market, we are at 178.27. So actually the IWM now futures moving back down a little bit. So we're pretty close to that 178.11 level. And that was the low right there that you can see. And that was in the morning at the very open. So what I'd like to see is opening above that 178.11 and then moving higher, continuing this pattern, short-term pattern of higher highs and higher lows. If we move back down, I don't think that's the end of the rally. But in the short term, it definitely changes things because we have put in a lower low. Transports, you can see that downtrend line there broken. But again, that similar, almost like a shooting star kind of candle. Actually, it is a shooting star kind of a candle. But we did close above the open. I would say, and I'm looking to see if I see any on here, this one right over here. You see how this one came off of this long, big move to the upside intraday, came back down and closed with a filled black candle? That means we were up for the day, but we actually closed below the open. In this case, we're up for the day, but we closed above the open. So we never went back down and closed, took out that opening price. So that was maybe one little positive. And the other thing that I would say is when we see these tails, to me, they're more bearish if you take out a key prior high. And so 15.2, 15.250, that's a key level for me to the upside. So if we get through that and leave a tail and come back down, that would be a little bit more bullish, or excuse me, more bearish short term. IWM did do that. It did come up above some key areas of resistance. That was a gap resistance level that we tested. Let me give you the numbers here on that IWM. So the gap resistance level was 179.02. That's where we closed on September 20th. Opened the next day at 177.67. And since that time, we have not seen an open or close above 179.02. This open 178.97. Close, but no cigar. Here we opened and closed 178.35 and 178.77, but no close above 179.02. So that's your first key level on the IWM. That's the one I'm going to be watching from a closing perspective. If we get through that level on a close, I think that opens up the next move, which I believe could be the 190 level. So that's what I'm watching. But again, that tail right there, we had that gap filled and we were ready to take off, and we ended up coming back down and closing below it. So a couple of short-term cautious signals here on the IWM, but more intermediate term, taking out that downtrend, now reversing, putting in higher high, higher low, higher high. Hadn't seen that during this entire recent correction. So there are positives, more intermediate term positives being offset by maybe one short-term negative with that candle from yesterday. All right, moving on, chart of the day. So anybody wants to get the chart of the day, go over to EarningsBeats.com. Monday, Wednesday, and Friday is when we send that out. And all you need to do is subscribe, name and email address, hit the subscribe button. There's no credit card required. You can unsubscribe at any time. We'd love to have you. Also want to mention, this isn't going to stay up on our site forever. We're offering this for free. I call it the Bowley trend. Pure coincidence, I guess. But I have developed a lot of trends. I've analyzed a lot of market history, stock market history on the S&P 500. I want to share it with you. It is, I think, a 7-page PDF that really gives you some very, very interesting trends. Go to EarningsBeats.com, download that free report. I promise you, if you haven't heard some of this information I've talked about in the past, you're going to be really surprised by how the market works. So make sure if you haven't already, click on that and download that free report. So what's the chart of the day for today? Well, one that I actually like, and I might trade today. I saw it after the close, so I didn't do anything yesterday. But Mara came off the bottom here, gapped up on heavy volume, didn't really have any follow through. We went back down, tested gap support, and we had a false breakdown about a little over a week ago, followed by a false breakout the next day. So there's been a lot of back and forth, but I really liked that volume yesterday. Strong volume and closing above 10. So this is one that I think could make a push to the upside. It is a very risky stock, not for everyone. You got to really think maybe more with a gambler mentality to be looking at a stock like this, or especially buying it. But that's completely on you if you decide. I'm just pointing out, it looks like an interesting breakout to me. The volume is heavy. Any kind of a short-term pullback into the upper nines would be interesting. I think if it did go back down to the 20-day moving average after breaking out with volume, I think that could present a really nice opportunity. To the upside, first, we just got to take out this intraday high. If we can get through that intraday high, I believe this is a stock that could run close to 14. And we're talking about a $10.24 stock. So volume trends you can see picking up really nicely. And I just like this breakout. If you go back here, back into April, May, and early June, see how we went sideways for an extended period of time? and then the volume picked up and we had a breakout. That's what led to another, I don't know, probably 60, 70% rise over the next week, over the next month, next few weeks to a month. Here, and I don't know if this is going to be the same thing, but we're getting a similar type pattern, sideways, and a breakout with increasing volume during this. So I thought it was interesting to point out. Do with it what you want, but I'll be looking at it today and trying to decide if this is something that maybe I want to take a shot with in the near term. Let's go. I had a question. We're going to wrap up the show with this question. A member wrote in, and I think it just came in either this morning or yesterday. But the question that came in was, do we have a negative divergence on the NASDAQ 100 on the weekly chart? So I'm going to show you the weekly chart, and I'm going to show you what the member is asking about. So we've been running up. You can see that PPO has been going higher and higher. And here we pulled back. PPO comes down. And now on a weekly chart, we're breaking out. We just had the highest weekly close. So we're comparing closes. Of course, got a couple things. Number one, the week's not over. So we don't know that we have a weekly breakout yet. So jumping to a conclusion that we have a negative divergence, I think that's what you're doing. You're jumping to a conclusion that on Friday, we're going to have a higher close. We don't know that yet. Remember, weekly candles are a little bit different than daily candles because daily candles, it's just the end of the day. Weekly candles don't complete until the end of the week. So that's point number one. Point number two is we have had a massive rally, and that weekly PPO jumped up to about 6 or 6.5. You go back and you look over the last 11 years since the secular bull market has been in play. How many times do you count the PPO, weekly PPO, going through 5? Because as I look back, I count 1, which was that pandemic move off of the pandemic low and then the big move up. Here, this is coming off of the cyclical bear market low, and then we're coming back up. But when these happen, when you come out of these cyclical bear markets, because prices are so depressed, you're going to have brief, well, sometimes not so brief. I mean, in this case, we're talking about several months. And back here, this kept going for 22 months. But we're going to have these steeper rises because prices are so beaten down. It's different than from being in an already established uptrend, like we saw early in 2013, 14, so forth. And then again in 2016, 2017, you just continually are moving up. You see how this has been different because it started off of a major decline, a cyclical bear market. So anytime that happens and you get a big rally off of it, you've got to keep that in mind, that you're getting a much higher PPO than you normally would get, which means what? When you get a pullback, like we had back in September and October of 2020, or a much steeper pullback like we saw in 2022, but really off of this uptrend, I'm talking about the correction that we've seen. That's a pretty steep correction. I mean, if you go back and you look at the history of the secular bull market, I mean, we've had, that was actually a cyclical bear, the trade war, fourth quarter of 2018, because we lost 20%. Here we lost, I don't know, 30%, 35%, whatever it was on the NDX. Cyclical bear market. Here we lost close to 40% from high to low. Cyclical bear market. But we had some correction, kind of like corrections like we saw back in 2018 early, maybe even that little one there in 2020. This whole thing in 2015, 2016 was a correction, never morphed into a 20% decline. I think maybe went down about 14 or 15%. So that is kind of similar to what we did here. But my point is with these negative divergences, number one, it's a weekly chart. So make sure the week finishes out before you make any call. Number two, I'm going to show you some other negative divergences that I think are somewhat similar to this one, if it does in fact print. And technically, by definition, it's a negative divergence. I'm not going to say it isn't. Higher prices with a lower PPO or lower MACD, that the definition of a negative divergence is that. Higher prices, lower PPO. But Couple things. Number one, you got to let this play out. You don't know that it's reversing here. Even if we get this breakout by Friday's close, you can't call negative divergences too soon. Let me show you what I mean by that. This was back in the end of 2020. What do you see at the end of 2020? Higher prices, lower weekly PPO. What happened after 2020? Did you see a big drop? Let's go back and look at what happened after 2020. There it is. So I just drew a line right here. There's that PPO lower. Here's that move up. We just kept going up all year. And the negative divergence stayed with us all year. Why? The reason why is because when you come out of the low and you set a really extended high on the PPO, it's very difficult to take that high out. So you're going to see negative divergences all year long. If you acted on the very first one, when you first broke out in the middle, probably right around November 15th of 2020, if you said negative divergences, I'm going to get out, look what you would have missed. Negative divergences are a warning. It's something to watch out for. It tells you risks are elevated, but it's not your primary indicator. And you have to understand that these do not always work. And I'm trying to give you some examples of what you can look for. So if this keeps going up, which I believe it's going to, I think what we're going to do is eventually we'll see the PPO work its way down. I think we already, with this extended correction, already worked down pretty close to the center line. It wasn't exactly a reset. We didn't get to the 50 period. We didn't get to the 0 line, but we got pretty darn close. And now we're starting to turn back up. But there's another one I'll show you here. And this is back in 2014. This was June 30, 2014, right here. What do you see? I see higher prices and I see a lower PPO. Now, what I really see is a negative divergence here where you went up, negative divergence, went back down below the 20-week, didn't quite hit the 50, didn't quite get to the 0 line, but we got close. And then as we went up, that PPO went right up with it. So you could look at this and say negative divergence. And let's see in 2014 what happened. June of 2014, here we were, right here. That's what I was just showing you. Lower PPO, higher price. Next year and a half, we kept going to higher highs and kept printing higher highs and higher lows. You'd have missed the whole thing based on that negative divergence. So again, let's wait for this to fill out the rest of the week. Number two, after these lengthy declines, you're getting close to a reset. Don't know if I would call it that, but I don't feel like this negative divergence, especially if there's no other warning signs, I'm not acting on that negative divergence. To me, it's way, way too early because, again, when you first break out, anytime you're in an uptrend, you go back and you look at charts, any daily, hourly, monthly, weekly, whatever, anytime you are in an uptrend and you pull back and turn back up again, when you first make a breakout, almost every time you have a negative divergence on the breakout. We don't know where the breakout's going. Have some patience. Let's watch this unfold. All right, markets open. Let's see what's going on. Currently, we have got a little bit of red. Interesting, the VIX is down with red everywhere, but VIX is, back down below the key 17 level, certainly way below that 20 level that we were talking about. And so right now, the market's kind of boring. The sell-offs aren't that great to the downside. And sometimes the move like yesterday was a pretty boring day. We didn't really do a whole lot. Get used to it because in a bull market, that's what we're going to see a lot more of. Anyway, Dow Jones right now down about 80, S&P down 3, NASDAQ down 33. You got small caps down 4 points. On a percentage basis, looks like small caps taking the biggest drop at this point, but still everything fractional in terms of the sell-off. Leadership here, by the way, Intel just continues to move higher. I've been talking about Intel for a while. It's in one of our portfolios. If you look at this chart, I'll wrap up with this. Look at this big breakout we just made. Nice double top here. We had pulled back for a few days, and then volume picking up, big move up through that 39 level. I mean, I think Intel looks like one of the better semis out there. I mean, it's not moving at the same percentage as, say, NVIDIA. So I definitely would give the nod to an NVIDIA, although NVIDIA just reached its high and could be looking at maybe a little bit of a pullback heading into earnings. I wouldn't be surprised maybe even to see maybe a 20-day test on NVIDIA. So we went right up to that 500 level, which is where we opened with earnings 1 quarter ago. NVIDIA reports earnings on Tuesday, next Tuesday afternoon after the bell. So get ready for that one. That could be fireworks for sure. All right, that is it. Everybody have a great day. That's my last show for the week. So enjoy the rest of the week. Of course, members, I'll be coming out with the daily market report today. It'll actually probably be out earlier today, and then tomorrow. So I'll keep you posted on everything going on in the market. Next show will be next Tuesday. And by the way, next week we'll have a holiday schedule. Probably, well, we'll definitely do Tuesday's show. Wednesday, the day before Thanksgiving, probably not. There's going to be a lot of people traveling. Normally, we don't see a whole lot of major market action the day before. So I haven't decided for sure, but obviously no show on Thursday, Thanksgiving Day. But Wednesday is iffy. May do shows, may not, probably won't. Got to think about it a little bit more. But anyway, thanks for tuning in. Those of you, obviously members, thank you so much for your support. Those of you maybe that are on the fence, great time to give us a shot. Go to EarningsBeats.com. Click on that 30-day free trial. We're going to have our fall special. Again, it's coming soon. Haven't announced it quite yet, but it is getting close. It's our best deal of the year. So you checking us out with a trial right now would make a lot of sense. And to those of you watching on YouTube, the live stream, and for those maybe looking at the recording later, thank you all so much. Please be sure to hit the like button and subscribe to our channel. That will really help us. Have a great day, everybody, and enjoy the rest of the week and your weekend. Happy trading.